Good afternoon. Good afternoon. It's Monday, the 26th of January. Welcome to another edition of Monday Market Picks. My name is Thilan Wickramasinghe. I'm the head of research for Maybank Securities here in Singapore. Now, the current global geopolitical volatility kind of reminds me of Game of Thrones with all the surprising turns that are happening. And one of the books in Game of Thrones is called The Song of Fire and Ice. Well, today's show is actually dedicated to something a little bit more stable. So we're going to call our show today a song of water and gold, and that's what we're really going to be talking about a lot more today, especially with gold passing $5,000 an ounce. We have Jarek joining us to discuss his latest buy calls on water contractor Sanli, as well as offshore and marine player Marco Polo Marine. We then turn our attention to gold with two of Singapore's three biggest pawn brokerages, MoneyMax and ValueMax. We met their management recently. And I'll also briefly touch on iFAST as well as C Limited as well, where we have strong buy calls. Plus, we got some fresh trading ideas from our chart guy as well. So quite a lot to go through in today's show. So let's start with Sanli. Now, Jarek, welcome to the show. Now, Sanli recently raised about 10 million Sing dollars from institutional investors. Now, this was mildly dilutive for the stock. Why do you think this was actually needed in the first place?
Hi, Thilan. Thanks for having me. Yeah, so I think if you look, at Sanli, after the first placement of $4 million, they've won about 500 million of projects, 500 million of projects from LTA and PUB, and their order book has never crossed 300 million previously. Yeah, so their equity base is very small. So with these huge new orders, they will need to raise their equity base in order for them to obtain more project financing for these projects. So the reason for this 10 million raise is actually purely for working capital, because they have won all these big projects. So they need more working capital to fund all these projects.
I see. Now the company is also facing some liquidated damages demands from one of its major customers. Now, should we be worried about this? What's the downside impact from this?
So I think from what we think, the company remains very confident that they do not have to pay anything and they are not in the wrong, whereas the consultant is the one that's in the wrong. So now the company is in talks with PUB to try to mitigate this issue, and PUB has really stepped in to be the judge of this issue. So based on their conversations and based on the evidence that they have, they remain confident that this issue is not their fault and that they do not have to pay any single amount of damages for these liquidated damages. And if you look at the PUB, the letter that's sent to them, basically there's no amount stated at all, and the project has already been completed. So if PUB wants to really file a big claim or amount, the amount will have been reflected in the letter. So I think it's more of a process than a real filing. So management is remaining confident that they don't have to pay anything. So our stance will still remain as of that with the management.
Got it. Now you're reiterating a buy call on this stock. Why is that?
So basically, I think if you look at Sanli wise, there's the potential to actually have a record multi-year growth story, and profits could actually potentially more than a double every year, depending on how's the execution. So we do think that a contractor with PUB, with PUB as his main order book and then breaking into LTA, and there's a lot of projects upcoming for PUB and both LTA as well, for Singapore. So they are on track to actually grow quite substantially over the next few years if they execute properly or normally. And we do think that at the current valuation of 100 million market cap, the potential profits that they're going to bring in could make them seem very cheap as compared to other players. So we do think that there's a lot of upside for Sanli, and this remains to one of our top pick, for the small mid cap space.
Okay, Jarek. Now I want to move on to another kind of water player, Marco Polo Marine. Now, Singapore billionaire Michael Kum actually acquired about 4% of this company recently. You say this is positive. Why is that?
Sure. I mean, honestly, this guy is a legend, especially in the veteran space. I mean, in the marine space, he's basically, I think if you look at his track record, he has sort of never been wrong, in all his investments. And the investments has came back multi-bagger, over the years that he's invested in. So just to give an example, he actually founded and integrated McLean Offshore in 2024 until 2004, and then grew it to quite a large company in over the years. And in 2008, he sold it for Macquarie Group for, I mean, the amount is not stated, but I think estimated to be about 300 to 400 million from there, right? And then he actually offloaded his stake just before the global financial crisis. So you may say he's lucky, or he's actually very sharp, in terms that this is going to be the peak, but then again, he actually acquired a stake in Atlantic Navigation at a majority stake for 26 million US in 2018, right after his exit from the, I mean, after the oil price crash and starting to recover, he went on to this Atlantic Navigation, which was listed in Singapore, and then in 2023, 2024, the fleet alone was sold for 183 million US. Right. So if you minus debt and all, there's still 100 over million net, cash flowing to the company. So he actually more than quadrupled his investment in this company, right? So he also acquired another stake in Mermaid MMA Marine, which is then he also sold off for a massive profit. So you can see that this guy is actually a longer term strategic player. He's not there just to flip for 1-2 years. He's there for maybe 5-10 years if needed. And the fact that he sees value in Marco Polo, even at 13 cents a share, shows you that he's not he sees something that validates what we stand for as well. Marco Polo is going to be a company that could potentially more than double or more than 50% from these levels in the longer run. So with his validation, with his investment and validation, and he's not coming in small. He's already now at a 4% stake, and from what we understand, it is very possible that he goes above 5% because he's, based on his investments in the past, he all takes quite a big stake. So yeah, I would say that this is more like a validation in Marco Polo that he sees value as well. Same as us and other investors.
Okay. Let's just go down to the fundamentals of Marco Polo. How are you thinking about earnings for this company in the next couple of years?
Sure. I think my numbers are being quite conservative because I've not factored in quite a bit of these new vessels and also the new CSOV that's going to upcome. So if, for us, I'm just factoring a 15 to 20% growth for the next 2 years. And subsequently after that, it could actually surprise on the upside once chartering rates are going up. And also if they have, they have currently capacity for more 2 large vessels for shipbuilding. And if they actually win more shipbuilding contracts, then there's a very big uplift to our numbers. So the shipbuilding margins are about 5 to 10% net, I would say, to be conservative, maybe about 6-7% net margin. And for example, the one that we recently won 200 million is supposed to be complete in the next 2 to 3 years. And 200 million means if you take about 6% net margin, that's 12 million of profits. Divided by 2 to 3 years, that's 4 million profit a year, which is about 10% lift from our current profit numbers. So if they win another 2 large vessels to build, you could potentially adjust our numbers by 20 to 30%, depending on the net margin of the assumption. Yeah, so there's still potential for more upside earnings despite us having a 17.5% growth for the next 2 years.
Got it. Now the stock's already up about 70%, but you're saying there's still quite a bit of upside. Any sort of key drivers that we should be watching out for Marco Polo?
Sure. So I think if they actually win more shipbuilding contracts, that could potentially be another re-rating catalyst. And also the next thing would be then to refresh their fleet. So if they are able to actually sell their fleet and then buy new vessels at a cheaper or more ROI return kind of investment, then that could potentially also mean more upside in terms of chartering rates. So for example, they can actually sell off their old vessels that are generating less chartering rates and invest in vessels like CSOV or all, which has a higher ROI, that could potentially help to lift earnings as well going forward. So these two factors could potentially be the re-rating catalyst for Marco Polo.
Got it. Have a look at Jarek's note today in our newsletter for more information. Now let's move on to, that was water. So let's move on to gold. We recently hosted the C-suite management of MoneyMax, ValueMax, and iFAST for Investor Day in our office. Actually, it was just a few days ago last week. Now let's start with MoneyMax and ValueMax, which we think of as less of traditional pawn shops and more as yield generating proxies to gold. And I think that's quite timely given the fact that we've seen gold prices skyrocketing, and given this global uncertainty, we think that gold prices will remain pretty well supported, at least in the medium term. Now, at a high level, both companies are structurally levered towards rising gold prices, but crucially, they monetize that exposure far more efficiently than holding physical gold. If you hold physical gold, it pays you nothing. But these companies have the ability to actually monetize the gold. Higher gold prices increase collateral values, which means that they can actually make out bigger loans and accelerate turnover in both pawnbroking as well as gold trading as well. This creates a double uplift to earnings, interest income from short tenor loans and trading margins from recycled or even some of the unredeemed gold that they hold. This is what differentiates them from a passive gold investment. Instead of just riding spot gold prices, MoneyMax and ValueMax generate recurring cash flows, which supports dividends and steady ROEs through the cycle. In that sense, they act as an income-bearing alternative to gold investments. Now, both groups also balance their B2C or business-to-consumer pawnbroking and B2B or business-to-business gold trading, which is important. B2C provides sticky customer relationships and repeat transactions, while B2B drives volumes and scalability when gold prices are elevated like this. That mix has proven pretty effective for them in the current environment. Now, there are some differences between the two companies, and I think that's where the execution divergence happens. MoneyMax is, I think, a little bit more on a growth mode with Malaysia as their key engine. Management is scaling its wholly owned store network after re-entering the market there independently, prioritizing outlets with stronger profitability and tighter operational control. Now, differentiation matters here. They also have drive-through pawn shops, and they have the largest of its kind amongst peers. And this actually improves efficiency as well as customer throughput as well, because you can service a lot more customers faster. Now, at the same time, demand for GST exempt pre-loved gold continues to accelerate, which offering built-in value to consumers as gold prices climb as well. So it's interesting that secondhand gold doesn't actually have GST, so there is a margin that can be made there as well. ValueMax is taking a more capital efficient path. Growth is driven by incremental store openings and disciplined M&A, particularly acquiring independent pawn shops facing succession challenges. In Singapore, there's quite a lot of independent pawn shops which are not really, where there aren't any second generation successors. So this actually has created a market for ValueMax to go in and buy some of them out and then integrate them into their network. They also maintain a pretty conservative balance sheet, pretty low leverage, tight lending standards, and they also have a higher B2B mix, particularly in terms of gold trading as well. So overall, I think very interesting and very opportune right now, given the significant interest in gold. Do have a look at these two players, and there's a note in our newsletter today with a lot more takeaways from what management said. I'm also going to quickly now turn to iFAST. The narrative is different, but also compelling. We had their management also in last week. Assets under management, or AUA, assets under administration, or AUA, growth remains the core driver, with assets up nearly 30% year on year on broad-based B2B as well as B2C inflows. Unit trust subscriptions are holding up well, and falling interest rates are actually supporting more portfolio reallocations to AUA rather than people keeping money in deposits. At the same time, the iFAST Global Bank is gaining traction with a growing deposit base and a clear path to full year profitability as well. Now, the real medium-term catalyst, however, is Hong Kong. The EMPF project remains on schedule with trustee onboarding nearly complete, and iFAST is set to take over day-to-day operations once that goes live. Beyond the initial contract economics, this positions iFAST as a digital backbone for Hong Kong's pension infrastructure, opening longer-term opportunities for adjacent B2B opportunities as well. So we maintain a buy on iFAST. Now, lastly, I want to give a quick note on C, which Hussaini just published today. It's also in our newsletter. The outlook for C is improving, particularly on the e-commerce side. The key theme is competitive rationalization. Across Shopee's major markets, we are seeing clear signs that the subsidy-led competition in 2025 is easing. In Brazil, Mercado Libre is raising shipping fees, effectively rolling back last year's very aggressive incentives. This supports the view that pricing discipline is returning and validates Shopee's earlier commission increases. In Southeast Asia, TikTok Shop has also raised seller commission rates in Indonesia. Importantly, its blended take rate is now higher than Shopee's, which signals a shift away from growth at all cost behavior. With Lazada continuing to lose share, we see ASEAN e-commerce converging into a more rational two-player market, which is positive for long-term margins. Taiwan remains Shopee's most profitable market, and developments there are also pretty supportive as well. Coupang, which initially raised competitive concerns, is now facing execution challenges, including a leadership change and cybersecurity issues as well. Our checks also suggest that competitive intensity has also softened, easing pressure on Shopee's profitability there. Overall, we see a more favorable operating environment emerging for Shopee's e-commerce business, improving margin, solid balance sheet. So they are very well positioned. So C is very well positioned to deliver some sustainable earnings growth. The stock has come off from its peak last year, so this is a good accumulation opportunity, and we do have a buy on that stock. With that, let's turn to our chart guy. He's got two brand new ideas. One of them is actually Sanli, which Jarek talked about from a fundamental point of view, but our chart guy thinks there's a technical reason to buy Sanli as well. It's been trading on sideways currently, but the structure is leaning more towards the bullish side. So there is upside there as this stock starts to move. Then we also have Oiltek International. Share price decline now seems to be slowing down and reversing, and it's actually finding some strong support as well. So do look at both of those charts as well. With that, let's look at some of the upcoming events that we have. We've got results season starting with the REITs already coming out. We had Suntec, now we got Mapletree Industrial Trust, CapitaLand, Ascot REIT coming towards the end of this week, and Keppel DC. I think a lot of investors will be following this given the interest around the data centers, and that's on 30th of Jan. And then we have SGX results out on the 5th of February. And I think, again, there will be quite a bit of interest on SGX given the EQDP program and hearing from management on that. So we will be covering all these results as they come out. So do subscribe to our research, and also do join our show. We will make sure that you are up to date on these results. And finally, this weekend is our market outlook and feng shui event at the SGX auditorium. Quite a lot of ground to cover. We are expecting a very strong turnout. So if you haven't signed up yet, please do so now. Spaces are very limited. There will be lunch and bento boxes served as well at the event. So do join us. I hope to see as many of you as possible next Saturday. And with that, have a profitable trading week, and we will see you next week.